Hello, everyone. This first session is designed to provide you with an overview of the financial markets and instruments that we'll discuss over the balance of the term. These instruments can be distinguished along two dimensions: primary versus secondary markets, and money markets versus capital markets. Primary markets are those used by corporations and governments to raise funds. Let's assume that a beverage company wants to expand their production plant, but lacks the internal funds to do so. The company can raise the funds by issuing stock, which entails giving up partial ownership in the company in exchange for the funds raised. If the company is issuing stock for the first time, this is referred to as an initial public offering, or IPO. Since Coors is already publicly traded, the additional shares issued to raise the money needed for the plant expansion would be considered a secondary offering. The important point here is that primary markets are used by companies and government entities to raise funds in exchange for something else, either the promise of repayment with interest in the case of debt securities, or a fractional ownership interest in the company in the case of stock. Most primary market transactions are arranged through investment banks like Goldman Sachs that serve as intermediaries between the issuer and the investors. These investment banks provide the issuer with advice on the securities, such as the offer price and number of shares, and also work to attract investors who may be interested in the offering. Once stocks and bonds are issued through the primary market, they are traded by investors like you and me in the secondary markets. Secondary markets offer benefits to both investors and the issuer. For investors, the secondary markets provide liquidity. Liquidity is just the ability to turn an asset into cash quickly at its fair market value. The issuers are not directly involved in the transfer of funds, but do receive information on the current market value of their securities. And this is what we refer to as price discovery. The securities are traded through one of the established exchanges. For instance, US stocks are typically traded through either the New York Stock Exchange, NYSE, or NASDAQ. The second dimension is money markets versus capital markets. Money markets trade debt securities and other instruments with maturities of 1 year or less. So those investors with excess funds can lend them to those with short-term needs. Money market instruments include T-bills, which are short-term obligations issued by the US government, federal funds, which are short-term, typically overnight lending between banks, commercial paper, which are issued by companies needing to raise cash, and finally, certificates of deposit, which are bank-issued time deposits that specify the maturity date and interest rate. We'll talk about these instruments in detail in the coming weeks. For now, you just need to be aware of what they are and who they're issued by. It's also important to note that because of their short-term nature, there is little risk of loss, so the return is also low. The money markets don't exist in a fixed location. Rather, the transactions occur via phone, wire transfers, and computer trading. As a result, money markets are considered to be over-the-counter, or OTC markets. Here you see the proportion of the market that is invested in each of the instruments we discussed. A couple of observations. First, T-bills represent about 1/3 of the total money market instruments. Second, bankers' acceptances, which are promised future payments guaranteed by a bank, are virtually non-existent these days due to their cost. These instruments were traditionally used to finance international trade, when you were paying for goods you'd receive in the future, which were coming from overseas, and wanted a guarantee that you'd receive what you paid for. Banks were willing to provide that guarantee, but it came at a cost. Finally, commercial paper markets collapsed during the financial crisis and have grown more slowly since. These markets represent a cheap form of financing for large, well-known companies. While money markets are debt instruments with maturities of 1 year or less, capital markets trade equity and debt securities with a maturity of more than 1 year. Given their longer maturity, these instruments experience wider price fluctuations in the secondary markets. With the higher risk of loss, these instruments also offer a higher expected return. As an example, over the last 85 years, the average return on stocks has been 12% per year. This is higher than debt and money market instruments, which returned 5% and 3% respectively. This is an illustration of the proportion of securities that comprise the capital markets. A couple of things to note. The equity component went from 24% in 1990 up to 43% in 2000. This was the result of the dot-com craze that we had in the late 90s when the S&P 500 returned 37% in 1995, 23% in 96, 33% in 97, 28% in 98, and 21% in 1999. It's interesting that the stock market is 36% today. This reflects the sharp drop in the market during the financial crisis of 2008 and 2009, and then the 11-year bull market that ended in early 2020. A bond is an instrument where the issuer agrees to make interest payments on a specified date and then redeem the bond at maturity. In other words, it's a loan. There are two basic forms of bonds. Coupon bonds make interest payments, typically on a semi-annual basis, and then return the face value of the bond in the final payment. These coupon bonds are referred to as bullet bonds or straight bonds. Zero coupon bonds, on the other hand, do not make interest payments. Rather, they are sold at a discount, and the difference between the price and the face value represents the yield on the investment. For this reason, they are often referred to as discount bonds. Equity represents a partial ownership interest in a company. The return that stockholders receive come in two flavors: income in the form of quarterly dividends, and capital gains, which is the difference between the purchase price and the sale price of the security. Some companies offer more than one class of shares. In that case, typically one includes voting rights and the other does not. As a result, you'd expect that the one that has voting rights to be worth more. As an example, there are two classes of Google stock. When they issued the second class, they used a collar, which is a derivative strategy, to keep the price of the two shares in parity. When the collar ultimately rolled off, the price of the two shares began to diverge. The foreign exchange markets involve trading one currency for another. The changes in exchange rates also have an impact on the return of international securities. I've included an example here, which states that Jared, a Babson grad, invests $1 million in a Japanese corporation when the conversion rate for yen to dollars is 10 to 1. The corporation does extremely well, and Jared is able to sell his interest for 15 million yen 1 year later. If the conversion rate at the date of the sale is 12 to 1, how much will he receive? Well, to figure this out, Jared would purchase stock for 10 million yen, which would just be the $1 million multiplied by the conversion rate of 10. If Jared attempts to convert the sale price, which would be 15 million yen, into dollars when the exchange rate has changed to 12 to 1, then he would receive $1,250,000, which is just the 15 million yen divided by 12. The net result would be a 25% gain on the original investment. So in other words, only half of the gain generated from the appreciation of the company's stock will be realized on the conversion due to the change in the exchange rates. Obviously, this is a risk for international investing. This risk, however, can be managed or hedged through derivatives markets, as we'll see over the next few weeks. A derivative security is one whose payoff is linked or derived from another previously issued security, exchange rate, or commodity. These securities generally involve an agreement to exchange a standard quantity of an asset or cash flow at a predetermined price on a specified future date. The main purpose of a derivative security is to transfer risk to other market participants. A simple example is a put option on the market. Let's say that you're invested in equities and concerned that the market is going to be under pressure over the next few months. Obviously, you can address this by selling some of your stocks and either leaving the proceeds in cash or deploying them into other asset classes where the outlook is more favorable. But there are two potential problems. First, you'll have to incur transaction costs and, importantly, taxes. And two, you might be wrong. Maybe the market goes up rather than going down. Given your outlook, you can purchase a put option on the market, which pays off if the market does in fact go down. If it doesn't, then you benefit from the appreciation of your stock portfolio. So in this way, you can think of a put option as being akin to insurance. You still get to participate in the upside if the market moves higher, but you have protection on the downside if the market should fall. Derivative securities are traded on exchanges or over the counter. Exchange-listed securities are more regulated, more transparent, and generally involve little default risk for the counterparty. Some common examples are futures contracts, which are agreements to buy or sell an asset at a specified price at a certain future date, and options, which are contracts that give the holder the right to either buy or sell a particular asset at a later date at an agreed upon price. Over-the-counter derivatives, on the other hand, are non-standard, largely unregulated contracts that may involve substantial counterparty risk. Common examples there are forwards and swaps, which is an agreement between two parties to exchange a series of cash flows. As an example, let's say that you work for a bank that receives a fixed rate of interest on its loans. Obviously, these loans represent the assets of the bank, and they pay a floating rate on their deposits, which are their liabilities. The bank could use a fixed pay swap, which pays a fixed rate and receives a floating rate, to convert its fixed rate assets into floating rate assets, which would match up with the floating rate liabilities. The last major market that we'll discuss is the mortgage market. Mortgages are a form of debt used to buy land, buildings, and other real estate. These loans are differentiated along two lines: amortizing versus balloon payments, and fixed versus variable rates. An amortizing loan has fixed payments comprised of principal and interest that are paid over the life of the loan. Balloon payments, on the other hand, require interest to be paid over the life of the loan and then the principal to be repaid in one lump sum. These loans are typically used as a form of bridge financing. We also differentiate between fixed and variable loans. Fixed rate loans, as the name implies, lock in the rate over the life of the loan, whereas the rate on a variable adjusts periodically with changes in interest rates in the market. Since the cash flows on individual mortgages are uncertain, the loans can be pooled and sold as a unit through either a mortgage-backed security or a commercialized mortgage obligation in order to reduce risk. I've provided a summary of all the instruments that we'll be discussing over the next 7 weeks. As you can see, I've differentiated the instruments by market, participant, risk, and maturity. In our next session, we'll look specifically at debt securities. In particular, we'll explore the effect interest rates have on bond returns. Thanks for listening.